You've probably heard the saying, some traders stick around, some take bold risks, but it's rare to find someone who does both for long. Many people enter the markets thinking that chasing bigger risks will automatically lead to bigger rewards. In reality, that mindset wipes out more trading accounts than anything else. The urge to go all in to believe that one big swing will win it all is almost universal. It's wired into us, tempting us to double down. But in trading, that very impulse does more harm than poor strategies, bad timing, or even emotional slip-ups. Today, let's dive into why that fearless all-or-nothing trading style feels so natural, yet almost always leads to trouble. You'll hear real stories from traders who have paid the price. We'll reveal the mental trap that makes you keep throwing good money after bad, instead of knowing when it's time to scale back. Most importantly, we'll show you the key difference between those who just survive and those who truly thrive. And it all starts here, the number one reason why most traders crash and burn in their first year. Chances are, you've come across this advice: keep your risk to just 1 or 2% of your capital on any single trade. Maybe you shrugged it off, thinking, that's just for the overly cautious. I'm here to trade for real profits, not to play it safe. At first, I get it does sound boring. It feels totally against your instincts, like you're missing out on easy money if you don't go big. But that's exactly where aggressive trading reveals its risks. Picture this: you decide to risk 10% of your capital on every trade because you're feeling confident. Then you hit a rough patch, just 5 losing trades in a row, and suddenly half your account is gone. That's a hard financial hit, but the emotional toll can be even worse. At this stage, you're no longer searching for new opportunities or making clever moves. Your one and only goal is to claw your way back to break even. That's a completely different mental battlefield, one filled with stress and desperation. Now picture the steady trader. They consistently risk just 1% per trade. Even if they lose 5 times in a row, they're only down 5%. Is it annoying? Yes. Frustrating? Absolutely. But their bankroll is still intact. There's no panic, no urgent scramble to make up losses. They keep looking for quality trades and stay in a winning mindset, not survival mode. Picture this: one trader is stuck fixing losses while the other keeps pushing forward toward victory. That's the real difference, and it all comes down to how much you're willing to risk. Here's the key point: if you lose half your account, you'll need to double what's left just to get back to where you started. That means you need a 100% gain just to recover. Now, compare that to the cautious trader who's down only 5%. For them, it only takes a 5% bounce to get back on track. One trader now needs a miracle. The other, just a reasonable winning streak. This lesson isn't new, but it's one every trader should remember. Consider Jesse Livermore a textbook example of what can happen when risk control is forgotten. Back in 1929, Livermore became a Wall Street legend. He saw the crash coming and made his fortune by shorting the market, earning what would be the equivalent of $1.5 billion today. Livermore wasn't just famous, he was legendary. Books were written about his life, and both newcomers and experienced traders studied his strategies. For a brief moment, he seemed unstoppable, yet just 5 years later, he filed for bankruptcy. How does someone go from being nearly a billionaire to losing it all that quickly? In the end, it all came down to his carelessness with how much he staked on each trade. Riding high on a winning streak, he kept taking bigger and bigger risks, convinced that his past successes made him untouchable. Soon, he believed the rules no longer applied to him. But the market taught him a tough lesson, stripping away his fortune, not just once, but several times throughout his life. Near the end, Livermore wrote words that still echo with a deep sadness: "My life has been a failure." Let that settle in for a moment. Here was a man who once held enough financial power to impact entire markets, a man whose single trade could outshine what most people earn in a lifetime. Yet he lost it all, simply because he couldn't control his hunger for massive bets. It wasn't a flaw in his trading strategy or his ability to analyze the market. Instead, it became a matter of survival, the same trap that still catches countless retail traders today. So what really happens when traders start believing that bigger is always better? This is crucial to understand, because even the smartest, most experienced traders can fall into this cycle. You take a huge risk, and it pays off. Your brain lights up with dopamine. It's electric. Suddenly, you're convinced you figured it out. You feel unstoppable. That high becomes addictive. Next time, you raise the stakes even higher, chasing that rush. Why wouldn't you push harder? You've already proven to yourself it's possible. But then suddenly, you take a loss. It stings. The pain from losing cuts much deeper than the satisfaction of winning. Scientists have shown the distress after a loss is about twice as strong as the pleasure from a similar gain. Now your account is down and your mind is shouting at you, make it all back, right now. The urge to be patient and think rationally is often drowned out by a burning need to erase your losses, so you start taking even bigger risks on your next trade, desperately hoping to recover everything at once. This is called revenge trading, and it's the silent killer of most trading accounts. People often blame poor strategies or bad timing, but the real culprit is emotion, made worse by risking too much. Conservative trading protects you from this psychological storm. When a loss only costs you 1%, it's frustrating, but not catastrophic. You stay level-headed, instead of getting swept up in the whirlwind. Wins are satisfying, but they shouldn't send you chasing glory on your next trade. Managing your risk helps keep your emotions in check, and that's what keeps traders in the game. Staying calm and logical is key. In the fast-paced, chaotic world of trading, reason is your lifeline. The market is relentless and indifferent. It doesn't care about your hopes or fears. Yet your emotions influence every move you make. Let me share a story about two traders. Both started out exactly the same. Each had $25,000, learned from the same online gurus, read the same books, and practiced on the same trading simulators. Skill-wise, they were a perfect match. The first trader was eager for quick results. Tired from his day job and desperate for a way out, he saw trading as his ticket to freedom. To speed things up, he risked 5% of his capital on each trade, hoping for bigger returns to match his effort. But what happened next? In just 6 months, his account dropped to $8,400. One harsh month almost wiped him out completely. The stress became overwhelming. He lost sleep, his relationships suffered, and he grew obsessed with tracking the markets. Trading wasn't just a passion anymore. It became a constant source of anxiety. Trader B, on the other hand, took a slower, more methodical approach. He never risked more than 1.5% on any single trade. Trader A scoffed at this, calling it boring money, and argued that such small bets would never get him anywhere. But Trader B wasn't after thrills. He had a day job he didn't mind, and he chose to focus on building steady, consistent results, one step at a time. After 6 months, his account had quietly grown to $31,200. There were no dramatic windfalls or big stories to tell, just steady, patient progress. But the real story was happening beyond the numbers. Trader B slept soundly at night, rarely facing drawdowns greater than 11%. Yes, there were a few tough moments here and there, but nothing serious enough to shake his confidence or throw his life off balance. Meanwhile, Trader A watched his account get cut in half, not just once, but twice. The stress poured into his family life. Arguments flared, tempers snapped, and unhealthy coping habits started to take hold. Trading, instead of lifting him up, turned into a destructive force. 12 months later, Trader A called it quits. He walked away, convinced the entire trading world was just too stressful, too risky a crooked system. He firmly believed it was all a rigged game, stacked against the everyday person. Trader B is still in the game, years later. Now he's managing an account that's deep into the 6 figures. Over time, his account grew large enough to support him. Only then did he quit his day job, and he did it from a place of confidence, not desperation. He used the same basic strategy, faced the same market conditions, and started with the same bankroll. But the key difference? How much each trader was willing to risk. That one choice sent their lives down completely different paths. Now, picture March 2020. Markets were thrown into total chaos. Global turmoil sent stocks into wild swings, 20, 30, even 40% in a single day. Circuit breakers were tripping left and right. The VIX, which tracks market fear, soared to heights not seen since the 2008 meltdown. Traders risking 10% of their accounts on a single move found themselves wiped out if the trade turned against them. In just a few hours, entire accounts, yes, the whole balance, not just a single position, could disappear. Stop orders failed, losses grew, and as slippage exploded, volatility chewed through traders' capital without mercy. I've seen traders who thought their risk controls were solid suddenly watch their positions spin out of control just because the market moved at lightning speed. Even those who limited themselves to risking only 1% per trade weren't protected from these wild market swings. They took losses too, and it hurt. But when a stock dropped by 30%, and that stock was only a 1% portion of their account, the damage was limited to 3% loss overall. Sure, it stung, but it didn't knock them out. They were hurt, but they were still in the game. Now, here's where things take a turn. That historic crash was intense, but it didn't last long, only about a month, maybe a month and a half. Then, the market came roaring back, rebounding at an incredible pace. The cautious, risk-aware traders managed to weather the storm, and when the market turned, they were ready. Many rode the wave back up and made some of their biggest profits ever. But the aggressive traders, they'd already been wiped out. With empty accounts, they could only watch from the sidelines as others seized the golden opportunities, scrambling just to pull together enough capital for another chance. Remember, volatility doesn't care about your confidence or how good you think your analysis is. It ruthlessly punishes oversizing, again and again. So what's the real playbook for professionals managing large fortunes? Most risk, no more than 0.5% to 2% on any single trade, never more. That's how the pros stay in the game. Top hedge funds and proprietary trading firms go even further, sometimes risking no more than 0.25% on one position. Think about that. These teams are filled with analysts and engineers designing advanced algorithms. They're constantly parsing real-time data, backed by decades of market experience. They have resources that everyday traders can hardly imagine. And still, with all that firepower, they choose caution over bravado. Why? Because they've embraced a truth that many retail traders overlook: the real key to winning is simply staying in the game. Preservation matters more than any single victory. Survival is the first step toward any kind of success. Legendary traders like Paul Tudor Jones have lived by this mentality for decades. His guiding principle: if a trade is turning sour and starts to stress you out, there's only one thing to do: just get out. But that advice only works if your trades are sized modestly. When you risk 10% per trade, every swing feels catastrophic. Paralyzed by the threat of a devastating loss, you start holding on to bad positions, just hoping they'll recover. Instead of cutting your losses, you let small setbacks turn into major disasters. That's how traders burn out, not because they lack skill, but because they don't respect risk. Now, here's a truth that often goes unnoticed, yet it might be the most important lesson for any trader: a major loss doesn't just drain your account. It takes away something even more valuable: your time. Time, unlike money, can never be bought back. Imagine waking up to find your trading account suddenly cut in half. Even if you're truly skilled, and even if your returns are steady, it can take years, real, actual years, just to get back to where you started. Lose 10%? You might recover in a few months. But lose 50%, and you could spend years celebrating several birthdays just to break even. And the impact goes deeper than that. Every month spent clawing your way back from a major loss is a month lost to compounding. That's a missed opportunity for your money to grow and for new possibilities to open up. This is the silent cost of reckless trading: months or even years of lost potential. If rebuilding takes you 2 years, you're not just losing a couple of calendar years. You're giving up all the growth and earnings you could have gained during that time. Those 2 years aren't just lost, they're years of compounding you can never get back. Years when the market was filled with possibilities. Years you could have spent steadily building your fortune. High-stakes trading takes away the one thing wealth depends on most: time. True success in the markets requires patience, long stretches of steady growth, and the readiness to act when real opportunity appears. But you can only do that if you haven't already sidelined yourself. Every crippling loss isn't just a setback, it can take years off your wealth-building journey. And most people don't have a lifetime to keep starting over. But what about those big dreams? What if fate smiles on you and you land a runaway trade that pays out 10 to 1? That hope fuels the argument for taking big swings, and the appeal is clear. Risk just 1% and score a 10 to 1 trade, and that's a 10% gain. But if you risk 10% and hit the same jackpot, you've doubled your entire account in a single move. On paper, it sounds irresistible. Here's the hard truth: most traders never stick around long enough to catch that miracle trade. If you're too aggressive, you'll likely be out of the game before you ever see that big payday. Losses are simply part of the journey. Even the best traders can't avoid them forever. The painful reality is this: if you take big risks, those unavoidable setbacks will wipe out your account long before you ever hit that elusive 10 to 1 win. Think about it. To even have a chance at landing that monster trade, you need to make hundreds, maybe even thousands of trades, and along the way you're guaranteed to hit some cold streaks. We all face losing streaks, no one is immune. If you risk 10% of your capital on each trade, even a typical run of losses can wipe you out, long before you ever catch that big win. Staying conservative is what gives you the strength to last, so you're still around when those rare, powerful runs finally arrive. Those high-return trades do come, but only to those who remain in the game. The math just isn't on your side if you risk too much. You'll be forced out long before luck has a chance to help you. I've seen this happen with my own eyes. There's one moment I remember clearly, a trader in a Discord group I was part of. He started his journey with $50,000, and for 2 months, his instincts for spotting promising trades were right on target. His account quickly grew to 71,000. Confidence soared, and his results started to draw attention. Feeling bold, he began sharing screenshots of his daily profits and losses, convinced he'd cracked the code. He started taking bigger risks, up to 8% of his account on each trade, justifying it with, "When you know, you know." But then, the inevitable turbulence hit. 5 losses in a row, something every trader faces, cut his account down to 45,000. That's when the panic really set in. Inside the Discord, his posts became more frantic. His focus shifted. Recovery became the only goal. He doubled his risk, now betting 15% of his account on each trade, desperate to win back what he'd lost. But 3 more losing trades dropped his account to just 26,000. Desperation took over. He abandoned his original strategy and started gambling on trades that weren't part of any plan, risking a staggering 25% of his capital, driven purely by emotion. Just 6 weeks after reaching a high of $71,000, his account had crashed to less than 3,000. The entire journey, undone in the blink of an eye. His final message popped up, a few frustrated words about how trading is a losing game for regular people. And then, just like that, he vanished from the group. I still remember him because deep down, he was truly talented. His chart setups always made sense. His market reads were sharp. But once he started sliding into that spiral of losses, none of it seemed to matter. I've seen this cycle play out time and again, taking big risks that lead to painful losses, then doubling down with even riskier bets, desperate to win it all back. Almost always it ends in total ruin. They call it the death spiral, and for those caught in its pull, it rarely leaves anything behind. Traders who practice careful position sizing avoid that dangerous path. They don't take losses large enough to cause panic. When you trade with the confidence that no single trade can ruin you, everything shifts. There's no desperation, no nervous sweating over the charts, and no constant adjusting of stop losses out of fear. All that remains is discipline. You stick to your plan, place your orders, manage your trades, and move forward. This calm mindset changes everything. Suddenly, your trade entries feel smoother. You step into trades without doubting your decisions. Your exits get better when you're not weighed down by anxious attachment to a position. You follow your rules not because you're forcing it, but because there's nothing tempting you to break them. Traders who take oversized risks can't relate to this kind of freedom. Their emotions become tied to every single result. When you're risking 10% of your capital, it's hard to remain objective. Instead of simply reading the market, you start seeing only what you wish were true. You might move your stop loss farther out, hoping for a win, or you cut profits too soon, just to feel that quick relief. Even if you have the right technicals and a strong plan, poor risk management can ruin everything by undermining your mindset. Here's the secret that many people overlook: mental strength. That psychological edge actually builds upon itself. Every time you execute a trade successfully, your self-trust grows stronger. Each time you stick to your own trading rules, the process feels more natural. In the end, you're not just building profits, you're building discipline. And that's the real momentum driving you forward. On the other hand, the aggressive trader piles up a record clouded by anxiety, wishful thinking, and lingering regret. Even their wins are bittersweet, as every victory rewards risky habits and adds more pressure to every trade. The turmoil becomes routine, and the stress never truly goes away. Over time, the psychological gap between these two types of traders grows wider. One stays calm, steady, and reliable, the very picture of consistency. The other is tossed between anxiety, impulse, and chaos. Both trade in the same markets and face the same challenges, yet their experiences couldn't feel more different. Think about Warren Buffett. His approach really comes down to just 2 simple rules. First, never lose money. Second, never forget the first rule. It sounds almost too simple to matter, but Buffett's entire life stands as proof that it does. With a career stretching over 7 decades, his biggest loss was around 50%, and that happened during the global financial crisis of 2008, when markets everywhere were crashing. Under normal conditions, his losses almost never reached double digits. He isn't out searching for huge wins every quarter, and he isn't gambling for spectacular gains. Buffett doesn't go after home runs. He focuses on staying in the game. His goal is straightforward: avoid catastrophic mistakes. By steering clear of disaster, Buffett stays in the race, letting time and smart decisions do the heavy lifting. It's this very mindset that sets successful traders apart. Those who build lasting wealth aren't usually chasing massive returns. Instead, they have steady hands. They stay active year after year, allowing the power of compounding to quietly build their gains. Remember, compounding only benefits those who avoid major setbacks. So, let's get practical. Forget the hype, leave the fairy tales behind. Imagine you start with $10,000. You're an average trader, consistent, but not extraordinary. You'll miss out on big moves. You'll make mistakes, and you'll face losses along the way. Some months, your gains are modest, maybe 3%, maybe 8% on a good run. There are months where you barely get ahead, and others where you might even fall behind. But your strategy is consistent. You stick to your rules, never risking more than 1% per trade. Over time, the results are clear. Your account keeps growing slowly, steadily. By the end of your first year, that $10,000 has turned into $14,000. There's nothing dramatic, just gradual, steady progress. Life goes on as normal. You keep your job. In your second year, you hit $20,000. And suddenly, your efforts start to feel meaningful. A year later, you're sitting at $30,000. Now you're really paying attention. Fast forward to year 4, and your balance has grown to $47,000. Friends start to notice and ask what your secret is. By year 5, your account crosses $75,000, maybe even more if luck was on your side. These aren't lottery-level windfalls, but they're real, sustainable, and come without constant stress. You sleep soundly at night, knowing that consistency is your true advantage. Now let's flip the script. Imagine the same scenario, but this time you're trading aggressively. Most traders burn through their capital before the second year is over, accounts wiped out by big risks and even bigger losses. Some keep going, only to start all over again, forced to relearn tough lessons about pain and patience. By year 3 or 4, they're exhausted, and their faith in trading is almost gone. But there's a stark contrast. The cautious trader quietly lets compounding work its magic. While others keep returning to square one, the steady hand builds real wealth slowly, surely, and in a way that lasts. This approach doesn't make headlines. No one is rushing to post a viral video titled, "How I Earned $47 this week by playing it safe." But the truth is, this steady approach lasts. It might not set your pulse racing, but it keeps you in the game, and that makes all the difference. Every time a trader wipes out their account and tries to fight their way back, they end up missing the most transformative moments in the market. Think about the rebound after COVID, the explosive growth of AI stocks in 2023, or the next big shift, whatever it may be. These windows of opportunity don't wait around for anyone. You only really benefit when your capital keeps working for you, when you stay in the market during those rare pivotal moments. If you're sidelined, worn down by losses, and scrambling to put together a new stake, those opportunities just pass you by. I've seen traders blow up not just one, but several accounts in just 5 years. They're always starting over, always picking up the pieces, always chasing after the big moves, but missing out on the ones that matter most. Had they focused on safety and steady growth from the start, they could be looking at life-changing results now. Instead, after all that effort, they end up right back where they started. Some people end up worse than empty-handed. They become jaded, frustrated, and start telling others that trading is just smoke and mirrors. But the real issue isn't with trading itself. The problem lies in taking wild, oversized risks. The market doesn't reward dreamers who rush in with loads of cash and a burst of enthusiasm. Instead, it favors those who are patient, those who show up every day, quietly putting in the work. When you're sitting on the sidelines, scrambling to recover losses, the best opportunities in the market keep moving ahead. And by the time you're ready and funded again, that window of opportunity has already closed. Take Marcus, for example. He's a bright, methodical engineer, someone who has everything it takes to succeed, at least on paper. Marcus invested $75,000, his entire savings. Confident in his analytical skills, he believed he could maximize his gains by taking on more risk, betting 7% of his portfolio on every trade. The first 6 months went well. His account grew to $91,000. His dreams soared. Marcus started picturing a life without his day job, and even began sharing those hopes with his wife. But then, adversity struck, a single tough month that would test everything. In just 3 rough weeks, almost everything Marcus had built was swept away. His balance dropped from $91,000 to $54,000. Stunned, he could barely process what had happened. He went back over every trade, searching for mistakes in his logic or execution. But the truth was clear. His system worked, his analysis was sharp, and his timing was disciplined. The real issue? Position sizing. He had simply risked too much. Shaken to his core, Marcus took a month off, stepping away from the market to clear his head. When he returned, he made a key change, risking just 1.5% per trade. It felt almost glacial, painfully slow. The days of posting flashy gains in chat rooms were behind him. The crowd didn't care, but he had changed. Over the next 3 years, his account steadily climbed, reaching $286,000. He left his engineering job behind, and now trading is his profession. His mornings are his own. He coaches his children's soccer team and enjoys a full life. Marcus once told me something that really stayed with me. I wish I had learned this before losing $21,000 and suffering through a month of soul-crushing stress. My system was never the problem. My ego was. The true revelation wasn't about technical skills. It was about mastering your own pride. Success didn't come from searching for perfect chart patterns or chasing after the newest indicator. The real key was gaining respect for risk and understanding that, more than anything, surviving in the market lays the foundation for everything else.